Hey everyone, if you're wondering why your investment returns have been, mediocre at best, even though you're hearing news of record profits and stock prices and you're feeling like you can do better, but you're not sure how or what's happening with your investments, then keep watching this video. Okay, you could have these two profit killers in your portfolio. Over the next 5 minutes, I'm going to walk you through step by step how to identify what's happening with your investments and why it is that you're not satisfied with your returns, especially if you're currently holding mutual funds. For those of you who are wondering why you should listen to me, my name is Michelle Hung. I'm an author and founder of The Sassy Investor. I've taught thousands of students to date how to invest in the stock markets. I'm also a CFA charter holder, which is a globally recognized investment management designation, and the Institute holds its charter holders to one of the highest fiduciary standards in the world. So in this video, I'm going to show you the two silent profit killers and what that could mean for your retirement years down the road if you don't fix this right now. So here's a sheet that I created, and you can have a copy of this after. Just shoot me a message or comment in the box below cheat sheet and I will hook you up with this. So basically, as an example, let's just say you have a current portfolio value of, I don't know, $25,000, and you're contributing $500 to your investments every month. Now, the annual cost of your fund, it's called the MER. So this is actually the first profit killer for your investments. It's a high cost, particularly mutual funds. So Canadians pay one of the highest mutual fund fees in the world at around 2.3% on average. Now that doesn't sound like a lot because what 2%, right? Well, I'm going to show you how much that can add up to. So let's just say you're paying the average fee, which is 2.3%. And that means, and that's an average. So there are fee funds that are higher than 2.3%. And then of course there are fees that are lower, but we're just going to use 2.3% for now, because that is the average in Canada. So for the risk profile, maybe I'm just going to use 5%. Okay. So when you went to the bank, when you first set up your portfolio, you probably have seen a lot of this too with the clients I work with. They come to me and they're like, what's happening with my investments? I'm not seeing a whole lot of returns. Well, it's because you were probably in low risk investments. Okay, so that's a second profit killer. For now, I'm just going to put 5% because that's the low risk. And I'll talk about that in a bit. So with this current portfolio, okay, if you're contributing $500 a month, you have $25,000 right now, and you're in a low risk profile. Maybe you're in some, conservative funds. You're paying around $575 per month on your per year on your funds, right? So the monthly cost of this fund is $48. Okay, and over 5 years, that amounts to almost $5,000 right here, $49.29 after 5 years. That's just the fees paid to your funds. After 10 years, that's $14,000. And by the 25th year, after 25 years, okay, it's $75,000 just for fees paid. And by 30 years, after 30 years, that's over $110,000 just on the fees paid on your mutual fund. So that is a lot of money. Imagine what you can do with that. And why is it so much? Well, it's traditionally what the banks have been selling to people. They're still selling it. The good news is there are a lot more options now. And when it comes to funds, there are a lot of low cost options out there. Okay, so ETFs, okay, exchange traded funds, will offer a lot of options for you, and they're a fraction of the cost. Okay, so let's just say there's you change your portfolio into a portfolio of ETFs, and the cost is around 0.18%. And yes, it is very realistic. There are funds, there are ETFs out there that are a fraction of the cost. In the US, there are funds that are like 0%. Okay, when it comes to fund fees, it is a race to the bottom because there's so many funds out there, there's so many options. It's basically like a commodity. So I'm just gonna put in 0.18%. And what happens is, I'm just gonna leave it at 5%. Okay, let's just say you switch your mutual fund portfolio to something of a similar risk profile. Let's just see what happens, right? So at 0.18% on your $25,000 current portfolio value, and you're contributing $500 per month, if you switch to a 0.18% ETF portfolio, the annual cost of your ETFs on your investments is now $45. Okay, so you went from $575 per year to $45, $48 a month to now $4 a month. Okay, so around like the cost of a cup of coffee. Okay, and over time, right here, your new portfolio is costing you $404 after 5 years, as opposed to $4,929. After 10 years, it's $1,200, as opposed to $14,000. And after, let's go to 30 years. After 30 years, that's $11,000, as opposed to $110,000. Okay, so these fees can add up to a lot of money. And luckily, there are options for you to switch out of these high cost funds and into a low cost ETF portfolio. So off the bat, right here, you do that switch. You can do that right now. And you can save yourself a ton of money by just, definitely by the time you retire, but even immediately. So instead of paying, every month $48, which is maybe the cost of all your like TV subscriptions and stuff like that, you're paying like the cost of, it's just costing you a cup of coffee, right? So these fees add up to so much money. And the portfolio difference is, right here, it's just this minus this, almost $5,000, and actually over $175,000. Because don't forget, the fees that you're paying, instead of paying the cost of it going to the bank or like the portfolio managers, you're actually able to reinvest that. Okay, so there's a difference. It's called like a drag difference, but overall, after 30 years, it's like a $175,000 difference. Okay, it's a six-figure difference by the time you retire, just from the fees alone. So now let's get to the second profit killer, which is the inappropriate portfolio. So as I mentioned before, maybe you went to the bank, you set up your investment portfolio, the person asked you, what kind of risk do you want to take? Okay, they have to do this risk assessment for you. A lot of people are like low risk, right? Low risk, I don't want to take it. I don't want to lose my money. So I don't want to be in high risk. I just want to be in low risk, right? Or more commonly, people will pick the middle, right? Remember in Squid Games when they were choosing, they were in that episode where they're choosing a number from 1 to whatever, like 15 or something, 1 to 14. And majority of the people will congregate to the middle because it's deemed as safer, right? There's being on either end is too extreme, right? One will certainly pay off. We saw that, and the other was just very, very unfortunate. It's just, which is very like undesirable, right? So it's very similar when people, when they ask you, oh, on a scale of whatever, 1 to 10, low risk to high risk, people automatically will just, congregate to the middle of the, middle of the pack because it's relatively, it's considered safer, right? So let's just say, but I see a lot of people, a lot of clients and students come to me and they're like somewhere in between low risk and medium risk. And that's when, a couple like years down the road, they're like, how come my investments haven't moved? Well, you haven't taken enough risk, right? So here's the difference between, let's just say this is your old portfolio. You were in a low risk low risk profile. You told the bank person low risk, right? But now, okay, after being educated, understanding that, there are portfolios out there that you can put yourself in that are higher risk, but your money won't go to zero. Okay, so even let's just say moving yourself up a notch to medium risk to 7%, the difference, the portfolio difference is massive, right? It ends up being a $10,000 difference on top of the fees, like switching from high cost mutual funds to a low cost ETF portfolio. It ends up being like over $250,000 difference after 25 years. Okay, and that's why I call these the two profit killers, because when you have a combination of a high cost portfolio and you're in a risk profile that's not appropriate for you, and especially if you have decades ahead of you before you retire, you definitely should be taking a lot more risk. A lot of people are afraid to take risks, but I say with the right education, good discipline, don't be afraid to take risk. Your money is being invested anyways, so you might as well optimize your risk. So even from 5% to 10 to 7%, going from a low to medium risk profile, okay, it ends up, the difference is like almost $500,000 after 30 years, right? And on average, that's like $15,000 per year. Okay, that is a couple of vacations. After a couple of years, that's a new car. Okay, imagine what you can do with the amount that you save, the amount that you can add to your portfolio just from increasing your risk profile and decreasing the cost of your funds. And of course, what happens if we, go even a little bit higher? You maximize your risk. Okay, here it is. It's almost like $1 million difference. It's $900,000 after 30 years. Okay, $500,000 after 25 years. And yeah, it's a big jump because the bigger the size of your portfolio, okay, these costs will end up being a lot. Okay, everything compounds, and on top of that, you're reinvesting all your profits. So the bigger the size of your portfolio, the more that you will see when it comes to the fees that you're paying. You're really going to feel it, and it's just going to add up to so much money very fast because of the power of compounding. So combined with high cost fees and being in an inappropriate portfolio, these two things can kill your investment profits and possibly break your retirement. Okay, these two profit killers alone, if not monitored, fixed right now, it can be absolutely super costly, right? Doesn't like even just, you see how a percent makes such a massive difference over time. So if you want help fixing this right now, let's hop on a call together for your free financial strategy session. And of course, if you want a copy of this sheet, okay, you can see for yourself. So you can see for yourself what's happening with your investments. What is it doing for you? Just leave a comment below, leave a comment, cheat sheet, and I will hook you up with this document.